Everyone to office hours for TradersPost on October 4th, 2024. It's October. That's what they call it, right? October for crypto. And I'm
Is
sure.
that as in opportunity tober? Opt-tober?
No, like a market go up. Number go up.
Uptober. Gotcha.
Yeah,
Okay.
excellent.
I'm behind the
Um,
curve.
I'm Tom Hartman, market manager here at TradersPost, joined as ever with Mike Christensen, CSO, and John Wage, CEO. How's it going, guys?
Doing well.
Now, I mean, it's not October, so my mood is down because crypto has not moved up the way that I wanted to. But hey, hopefully we get a nice 50% down, and I could buy it like I didn't buy it before.
No, don't do that. Don't do that.
I
It still looks good.
When we cover Bitcoin in our after hours show live, I do want to point out some changes that have taken place in the market that are worth kind of highlighting here as this descending trend on Bitcoin continues. And we're not seeing higher highs. Getting a little bit concerned here, but I won't give anything away too early.
Speaking of which, on After Hours, we will be talking. We will be revisiting the Coinbase paper Bitcoin debacle. We'll be talking about recession watch. I think that might be on the heels of what you're talking about over there, potentially liquidity wise. And we'll be doing a little discussion on Cardano versus Solana. But before we get there, as always, we like to go through your questions to figure out how to help you better and how to make the product that much better for your trading needs. So let's get in. And actually, there's one thing I wanted to show here, Mike, if you will. I'll ask you to share your screen in a second. Essentially, prop firms have become all the rage, not just here at TradersPost, but worldwide. People are finding it super interesting and super valuable to take on these challenges and to pass them and to essentially be trading other people's portfolios, other people's money in order to become a trader. You have started doing a mega thread on Twitter with your experience of doing this, of becoming a world famous prop firm trader. And I'm really eager to see the evolution of it. So if you haven't already, you can click on the link inside of the bio and go take a look at go follow along with Mike, because he's being very detailed and granular, which I like, and he's posting wins and failures, which I also enjoy, and it should be pretty interesting. I'm going to be happy for him if he passes the challenges and makes a bunch of money inside of the system, and then I'll also be I'll have Schadenfreude if he fails, like I do with my evaluations. So either way, it's a win-win.
Okay, good to know. I'm glad you're winning at the end. The interesting thing about the approach so far, of course, are the risk constraints, and I think this is probably the complaint that a lot of people have about these prop firm accounts, is that the risk controls are so tight that it makes it very, very difficult to get past. But I would say, like, my response to that is, even at the lowest account level for the eval, I think they want me to hit a $3,000 target with $2,000 of maximum loss on any given day, which sort of serves as it operates like a trailing stop in the account, because it never goes back down on each trading day. That makes it really difficult to have any kind of normal drawdown in the market. And then I guess, like, the other issue I have with these prop firm accounts is you have to close everything by 3 p.m. Central or 3:15 p.m. Central. So there's no real way to do any kind of swing trading where you're over multiple days or taking any kind of trend on a longer term horizon, which obviously encourages people to be in and out of their positions by the end of the day, or back into the electronic session after the market opens back up. So I mean, there's definitely some issues with it. It kind of forces you to be a little riskier with your money, but or with the fund's money, I suppose. And those controls mean that you have to be particularly focused on risk management. So for me, I went with M&Q. Obviously, ES or MES would be an even less volatile market to trade. But just trading one or two contracts of M&Q And, trying to manage about 200 to 300 ticks of risk means that I'm able to keep my my risk pretty small in the account. And to hit that $3,000 target, it's going to take 10 or 20 trading days total in order to kind of get there. So it's a slow and go approach. I think what often happens is people get in and start throwing around a couple NQ contracts, and you're already on the wrong path because you're putting too much risk on the board.
I'm wondering, John, what would it take to get you into the game?
I had a different thought. There's a guy I follow on Twitter, and he was talking about running daily strategies on his prop firm accounts. And I'm trying to find the tweet now. But you're saying that you can't hold positions overnight?
No, you just can't hold it past 3:15 p.m. Central, but you can open it back up when the electronic trading hours are back. So technically you can hold a position for roughly 23 hours, but you just have to close it out before the maintenance period.
Interesting.
So what that means is that
prop firms though that do allow you to hold it overnight, but there's special accounts that you have to choose for that.
Yeah, it's a fair point. I mean, every prop firm has different rules, different risk criterion, different holding periods. They let you do certain things. But I was mostly interested in Topstep because it was more popular, and they do support automated trading in their rules. So because automated trading is allowed, like obviously getting past the eval is one step of the process here, but then standing up one of my automated strategies is the next step once I get a funded account.
Like logistically, I don't know how would you do that if you were running an automated trading strategy on the daily chart? Would you just hard code logic to like close it and then open it right back up if you're still in the position?
Yep,
Okay.
That's it. Just close it out before 3 p.m. Central.
I wonder why they do that. Do you think that's like a technical limitation of their system, or is there like a actual functional reason?
It's a good question. I guess on one hand, there could be some quote unquote maintenance period risk where the bid ask spread blows up when the electronic trading session starts, and there's a big variance between where the market closed and where the market opens there. But given that they let you reopen at the electronic trading hours, I don't think there's going to be much difference between where it closed and where it opens back up. So even if you wanted to, you could just close the position out and then reopen in a slightly different strategy during the electronic trading hours, where volatility is a lot slower. Things are a little bit different. There's a little bit different of a trading approach that I think is necessary for the electronic hours.
So to answer the question, what it would take me to get me into it, honestly, I'm all for, and we're going to do it. We're going to build more tools for the prop traders. But personally, I'm more interested and excited in building all the long-term investment strategy tools, like the automated rebalancing, portfolio copying, things like that. That's kind of where my interests are right now. So I don't know if I'll be actively prop trading in the near future.
It's a different game for sure.
So you're scared?
Yeah.
Okay. So you're scared.
Oh, here comes the
I'm
challenge.
definitely scared. I'm definitely scared. I like to keep my money.
Then you can't be a trader.
Maybe I'm just weird. Well, I am a trader. I'm on different time frames, and I just operate differently. And running TradersPost and writing code and building everything, I like to put a lot of my energy into that. But it's kind of interesting. Like I built TradersPost because I was super active and doing all the active trading. But then as I keep progressing into my career, I just keep moving up in time frame and have less and less interest in kind of the intraday stuff. I'm all for people trying that and continuing to do that. I've just learned more and more about myself that that's not necessarily what I'm interested in.
John likes to lose money slowly. That's
that's
the game plan.
That's how I got into doing PineScript development, because I was doing scripts because I was like, well, why am I failing so much? And then as I started doing them, this is the joy, not the actual trading. So Excellent. All right, so we'll go. We'll start off with the questions for last week. As always, we take your questions from support tickets, from Discord, from social media, and from YouTube. So please, if you have any questions in the future, make sure you ask them there. It's been fun seeing people in the Discord group going, "Hey, my question was asked." I'm pretty happy about that. So it reminded me we got to be. We'll be posting the clips also into Discord, so you guys don't have to wait till to come on the stream in order to see it. But we're happy that people are coming out. All right. So, question number one: someone was asking here if it's possible. One moment. They want to know: is there any way to test a webhook without making a market order? Just want to know if my strategy is working. So they want to know. They want to test the signal from TradingView to TradersPost. So there's two ways you can do that depending on where you're going from. On TradingView, there's no specific option that allows you to just send a webhook through TradingView. I just right-click, add an alert on the chart near to whatever my price is, or have some condition that's always going to be true, and then just send a webhook that way. But then also on TradersPost, you can there is a send test feature that allows you to send a signal basically from the back end to your strategy just to make sure that that's working.
Which also means if you're sending that alert through an example price on TradingView, like one other thing here, if you don't want the trade to actually come through, you can either disable your strategy and then you'll still see the webhook log once we receive it on our side, but it won't actually go through to your subscriptions. The other option is to add test equals true in your JSON payload in the TradingView alert if you want to send that through. What that'll do is actually prevent the webhook from kicking off a strategy signal from there.
And you could also disable auto submit. I think that would be kind of like the last option, is like that way you could see it go all the way through and you would basically see the trade and the orders that would be sent. It just won't get sent to the broker, and then you'll have an approve and reject button, and you can just reject the trade and it won't get sent to the broker.
So we've got 19 different ways to do it.
Also, if you wanted to, let's say you wanted to send a signal and you weren't using TradingView, something like that, you had your own custom install, you could use like a service like hopscotch.io in order to send a payload to us. There's different services out there.
I'm so old. Hopscotch, man. I'm still like Postman. Is this like what the new kids are using these days?
Postman went like super paid like 8 months ago. I remember I was using that all the time.
See.
And then I think there was Insomniac. I think that's the term of it. And then that turned into some weird app use case that I don't use anymore. And so Hopscotch is what I use.
Yeah. Cool.
And it's free, so
out.
Can't really be.
For now.
Let me just make sure I didn't sign up to some free trial and forgot about it 6 months ago, which always happens.
It looks really cool.
Yeah, it's
you can just use it. That's sweet.
There's a bunch of cool features for it, and it's persistent. So if you come back again and again, you have all the different things there. It gives you the error messages directly in a console on the screen. So I really like it.
I use Talend, which is a Chrome extension, TALEND, and I've got a whole host of unit tests and all kinds of different stuff that I've built around that. So that allows me to build it by project and then execute all kinds of requests at the same time and verify that the results are what I expect. Pretty similar to Postman and this Hopscotch tool, but I hadn't heard of Hopscotch either.
That's cool. I was trying to see who built this. It looks like it's completely free and it's really well built.
Yep.
Microsoft.
Free.
Some
Just
dude.
give us everything who you are and your data and your privacy. Free. All right. So next question here. Someone was saying that they're having an issue with TradersPost. It's not trading both sides of the strategy. There's only buying that's happening, and when they're exiting happening, it's exiting to sell, but then the selling doesn't continue. And so I wanted to bring this up because someone in the Discord actually did answer this, saying that they didn't have side swapping on and they didn't have the both sides option active for their subscription. And so the selling that they were doing was exiting an open position that they had, but it wouldn't actually go ahead and open a short position. So this happens.
Well, you guys can just answer all the questions. It's like I don't even need to be here.
Tom's on it.
I'm just kidding. I'm happy that it's good.
Well, I wanted to bring up that what I liked about that was that I believe it's Chris inside of the Discord group that was answering the question. So I just wanted to bring that up as an opportunity because we had answered the questions before, but it's almost funny to try to. I always go read all the different support tickets and all the different questions, and to see John and Cam not get to the question in time before a user answers it, and I'll check the hours in which they're answering.
It's Chris with a K, right?
Yeah, Chris with a K.
Yeah, so he's a part of the community ambassador program. We have 2 people that are a part of that. I'd like to grow it. I'd love to build that up to maybe like 5 to 10 people. And we basically give the people who are a part of that ambassador program a free TradersPost account. And all that we ask is you be active in Discord and try to answer a couple questions every day and be a part of the community. So if you're interested in being a part of that, definitely reach out to us.
Oh, that's awesome. With that, do you think you might be interested in extending that to people who are on Fiverr and Upwork and have specific gigs and postings tailored to helping with TradersPost integration?
Potentially, yeah. I mean, if you have someone who might be interested, you can have them reach out to us. Is that you mean people who are like doing, like they are doing integration work and they need a way to test what they're building before they have access to their customer's account?
Yeah, sort of like instead of being in the Discord group to prove that their community supportness, they are posting the gigs to show that no, this platform is worthwhile versus potential competitors, and they're advocating, they're speaking on behalf of TradersPost, saying no, this is what I'll specialize in.
Got it. Yeah, I mean we can talk about it. Reach out to us if you want to talk about it.
Question someone asked, do we offer support on weekends? Not just the posting in on the support tickets or in Discord, but also calls.
I think both. Well, I know John for a while more than me had a compulsive need to always try to stay on top of support tickets. But lately, I think we've been trying to do a good job of letting go and, trying to take a break here over the weekends. We don't have a specific policy. Our hours are published on the site under our support page. We do try to take a break over the weekends, but I think eventually we'll probably be able to expand our service offering and help you guys over the weekend if needed.
Excellent. Is it possible for TradersPost to add a feature where a user is notified when there's like a race condition situation that might be happening, if signals come in too close together, as opposed to them messaging in and then we tell them that it might be a race condition?
It's a really good idea, actually. We do know.
I was going to say, we actually do have, like, if you send 2 signals at the exact same time for the same ticker and subscription, whichever one starts executing first will obtain a lock. And when the other one starts to execute, it'll see that the other trade has the lock, and it basically waits. So in theory, we could build something that whenever that logic happens, we kick off an alert. So it would be possible. Sorry to interrupt, Mike. What were you going to say?
No, that was a better technical solution than the one I had in my mind, which was to look at the timestamps. So looking for the lock and a collision on the symbol makes a ton of sense.
What I've seen is that so there's the people who try to send in a signal like within a second of each other. But then there are also circumstances where, let's say they're trying to give it 30 seconds or something like that, but then the signal doesn't get sent from TradingView necessarily at the time that they expected. So if there was like a window of like, if the signal came in within 30 seconds, okay, fine, your stuff went through, but maybe a warning that says, hey, but they came in pretty close together. So just keep that in mind.
Yeah. I almost wonder, as you look through the history of the trades, if there's a way to group those together in some visual way so that you get a sense of, these two came in and collided with each other.
We could definitely do that just on the UI and the surface level when we're rendering a list. We can look at the dates, and if there are 2 trades like next to each other that are within a certain amount of time, we could identify them in some way.
Yep. Always making improvements.
Yeah.
All right. So someone was asking, when using interactive brokers as a broker within TradersPost, do I need to have TWS or IB Gateway running so that you can connect through them?
No, we communicate to Interactive Brokers web API, and that's cloud-based. So no, you don't have to have anything running on your computer. Don't have to have TradingView open. Everything is in the cloud.
Yeah, I think that's like worth reiterating. There's no aspect of TradersPost that requires you to have a computer on once you've set up your alerts for your signal source. Assuming your signal source is something that exists in the cloud, like TradingView, like TrendSpider, nothing needs to stay on between your signal source and TradersPost and your broker. All of our integrations are in the cloud.
I've had multiple instances. I think we're 4 years into building TradersPost. And I've had multiple customers who've canceled and left, and they're like, "Oh, it's so easy. I built my own thing. I just run it on my computer." And then they always end up coming back because they're like, "Oh, my power went out, or I lost internet connection." And like, it's a perfect example. You gotta. It's a lot. It's easy to build a little proof of concept example, but it's much harder to build a robust, resilient system that will deal with failures and power outages and all the things that don't happen often, but when they do, it could be disastrous for your account.
And I'm going to tell you guys right now, as an engineer of 25 plus years, you're not going to write what we built in ChatGPT. There's a big infrastructure behind the scenes here.
Give it 3 months. Give it 3 months.
Oh, okay, Claude. Sorry. Yeah, Cursor.
Every 3 months, Tom was like, "Give it 3 months. Give it 3 months." I mean, it is getting better and better. I am a believer. I have fully adopted Cursor and AI in my life on a day-to-day basis.
It's made us faster. It's made us more productive for sure.
What's fun though is that you can never really be sure that the system is working the way that you want to if you built it using the AI tools, because you don't know every part of it, and so you're just like hoping. And so the idea that you would build something like that, okay, now I'm going to start running it, and I'm going to put $100,000 through there. I don't know. Yeah. I mean, I'd do that, but regular people, I don't think so.
If you did that, you would. I was going to say, if you did that, I mean, you would. Any software engineer that took that code would, probably write some automated tests to verify all the behavior. But YOLO, I guess, just let it ride. Don't even test it first.
We're 3 months away from it writing its own unit tests as well in an agentic way.
There you go. Now you're getting
it. I try to think about this though from like a non-developer perspective. Not knowing what it's actually writing would feel a little bit like in data science, building some black box model and not understanding why the predictions are so high from the inputs that you're putting in. It just feels like you're flying pretty blind, and some unexpected outcomes are going to happen if you're completely unaware of what's happening under the covers.
So have you used advanced voice mode in ChatGPT for it to explain to you how your code is written, and then you're having this back and forth with it, and it's really getting some of the nuances?
Yes, very much. I've been very impressed with advanced voice. Yeah.
Yeah. Well, I look forward to it. Well, the thing is, as AI advances, so will TradersPost. So whatever you think that you'll be able to create, well, we'll be able to do that much more on top of it. So good luck catching up.
The crazy thing is our audience right now has no idea that this entire script so far is AI, and that all three of us are AI avatars.
You have no idea how much I want to make that happen. That'd be so good.
Why did you guys make me look like this? Beefed me up or done something? Like, geez.
The stats show that the more casual the CEO of a company is, the more people trust it. That's how it goes.
It's true.
How it goes. All right. Second and last question here. If I cancel my subscription, do I still have access to the history of my trades?
Yes, we do not at the moment. We don't delete anything at the moment. But at some point in the future, we might. But there's nothing that does that today. But if we did build something that, archived accounts or something like that after cancellation or a period of inactivity, we would definitely send out notifications, and all you would have to do is like log in once to like reset your activity date, and it wouldn't get deleted.
If you disconnect your broker or delete your broker, however, from the platform,
Yes.
that unfortunately will delete your trade history.
Yep. If you can delete your strategies or your subscriptions or any of that data, and it will cascade the delete and will delete all the related data.
All right. And a last question here, broader in scope. Is there any point to trading a strategy that doesn't beat buy and hold?
I actually think this is a pretty good question. On one hand, I would say that your aim should be to actually beat buy and hold. On the other hand, it depends on your risk appetite and how much capital you've allocated to that strategy. If you look at the Sharpe ratio and the performance of the underlying asset that you're referring to, or the asset that you're trading, let's just say it's Qs, for example, or XLK, some kind of technology ETF. The max drawdown on that and the overall volatility can be pretty high. It could be, as much as like 35% or more. If that drawdown makes you pretty uncomfortable and your buy and hold, your strategy is built to trade trend within that range, and the overall absolute performance is less than the actual fund itself, you might ask yourself if your goals and objectives are to reduce drawdown and your strategy has, like, let's say a 10% max drawdown, well, then I think you've achieved your goals. So it just really kind of depends. Like, generally speaking, if your objectives are to beat the absolute returns, then yeah, you would want to try to focus on beating buy and hold as a benchmark objective. But if drawdown is actually something you're after, risk control is something you're after, then you may be comfortable not beating the buy and hold.
And many traders I know, at least, who use TradersPost and people who manually trade on a discretionary basis, their goal is to generate cash. Like it's their income.
Yeah.
They're full-time traders, so they need, like, they maybe could make more money if they were to just dump it into buy and hold, but they want to generate some income every month. So that's their goal. Like Mike said, depends on what your goals are.
Yep.
That's right. Actually, as you go on the hold, there's so many reasons to do it. Like, for example, the buy and hold has this it's implying this risk freeness. There's a risk freeness of holding the asset, and that's not true. You are actually open to this risk, and if you're, and we're not talking about, like, let's say, just flash crashes. We're talking about recessionary periods. We're talking about contractionary periods where it could be 2, 3, 5, 10 years of down market, and then we're not talking about buy and hold. Also, the having a buy and hold portfolio and then having some discretionary amount to then trade, you can actually end up making more than just if you buy and hold, while still be able to take certain risks. Same thing with leverage, right? If you could be using leverage, well, you need to be able to trade, and you can actually end up making more than on buy and hold. So there's all kinds of reasons why you might want to do it. And for me, the idea for trading is that it teaches you so much, just so much, of how to think about risk, how to think about opportunity, how to capitalize on things. It opens you up to this potential of this gain that you wouldn't have in another way, and it teaches you about macroeconomics, about microeconomics. And so, to me, trading is more than just like poker, right? Where you leave the table and all you knew was more about the cards. It teaches you about life, about markets, about policy, about governments, about all these different things. So if it were up to me, trading would be a requirement in high school.
It's definitely made me a better long-term investor. There's been scenarios where I've used the skills that I've picked up being an active trader to hedge my long-term positions or reduce at timely opportunities, and adding back in at the right opportunity. So yeah, it definitely helps you grow those skills.
Excellent. Perfect. Well, that's it for after hours. Nope, office hours for this week. And we're going to be starting after hours in a second. But before we do, we'll shove John right back into the engineering room, as we do every week. It's been a pleasure to have you here.
All right. See you guys. Have a good weekend.
See you, John. Have a good one.
Now for After Hours with your hosts, Tom Hartman and Mike Christensen.
After hours. TradersPost, one of my favorite times of the week, although I do love office hours as well. Mike, this week it's been pretty intense geopolitically, but in the financial realm, it's been interesting how relatively calm it's been, which itself is a weird indicator. But before we jump
Yeah.
on any of those news, I just want to go over some of the headlines that we're going to be taking a look at this week. First up is it's all about the economy. So we have the jobs number came out this week, and there's more jobs added to the market, and it really calls into question here what's going on with this 50 basis point cut that the Fed did a couple of weeks ago. So we have jobs up, we have unemployment down, and we'll be talking about that. Afterwards, we'll be hitting on the Coinbase drama from last week. We made certain statements, and I'd love to be able to revisit those in the next couple of minutes.
I got into hot water.
And then after that, there are no headlines for it, but I do want to jump into the Cardano versus Solana debate because I have strong feelings, and I'm very curious if what your opinions might be. All right. So first up, the numbers that came out for nope, this is the wrong one.
How do we design technology?
All right, let's try that again. So the numbers that came out for this week, we have average hourly earnings that went up 4%.
Yep.
We had the non-farm payroll that was way higher than expected, so 254,000 versus 147, and up from 159,000 from the previous reporting period.
Yep.
We have the and then the unemployment rate dropped from 4.2 to 4.1.
Good signs.
Well, these are good signs, right? These are good signs. And so what I was thinking about previously was that the Fed was cutting 50 basis points because they have access to the economic reports before we get them, and I thought that they saw some weakness coming in the future and that they wanted to go ahead and cut now preemptively, that they didn't want to be behind the ball the way they were with the inflation, with raising rates a couple of years ago. Then these numbers come out and you're like, hey, wait a second, not only did you guys cut, you cut more than you normally cut, and you're saying everything is fine. One thing I didn't put in this the slide here is that Jerome Powell spoke at the NABE a couple of days ago, and his whole talk was about how everything's fine and good, how the market's resilient, GDP is up, and everything is great. And no one asked, okay, so then why did you cut 50 basis points? You're supposed to do that when a problem is happening. Do you have any feelings, any opinions on this at all?
I do. I think the main indicator that the Fed, or what the Fed is likely signaling here, is that they're reprioritizing their focus from inflation risk to recession risk. So as we prolong high interest rates, we're keeping the cost of capital, pretty high for businesses, and that has obvious, impacts on the economy. It's actually what they're hoping for in the process of trying to curb inflation. Well, we've nailed it there. We've hit the target rate. We've achieved the goal, but in doing that, we're still keeping that risk of recession alive. And I think the aim is, of course, to try to curb some of that risk. So I think they were pretty aggressive in their stance and aggressive in their approach to try to get back on track to eliminate or at least reduce some of that potential for recessionary uptick in data. The data that they were looking at obviously gave them the confidence to say, okay, this is enough of an opportunity for us to pull back by 50, thereby not increasing the likelihood of continued inflation or reversal in the inflation trend, but also not exacerbating this recessionary trend problem.
Well, do you remember I think in May or so, when they were talking about, when the news cycle was talking about the potential rate cuts, they were thinking that we're going to get 25 basis points in July. And that one of the reasons that they might do that is that they wouldn't want to do it close to the election, the U.S. election, because that would be shown as favoritism or trying to get the incumbent reelected. And then they didn't cut in July. So then people were saying, okay, well, then they're going to wait till 2025 because they're not going to want to do it during the election season. And then smack dab, in the election season, they cut not by 25, but by 50 basis points. And if the economic weakness is not there, or at least they're not saying anything about it, then the case for that this was entirely political seems to be pretty good. Like that's what I was expecting all these headlines to be talking about. Uh, uh, Powell cuts 50% with a good growth data. This is completely a partisan issue, and I'm not seeing that at all, which makes me put on my conspiracy cap and I go, "Hey, that's then probably what the reason is." Did it strike you at all now, like that? Hey, maybe they are doing it for the election?
I just feel like I would be speculating. I mean, if I operate under the belief that the Fed is truly focused on economic data and there aren't hidden biases behind their decisions to impact other parts of the political landscape, then I would say, from a practical perspective, I feel like they're truly data oriented and they're operating objectively. But it's tougher for me to speculate on the things I think you're talking about.
So how about if we add on to the gumbo the longshoremen, the strike that was supposed to be happening, and then they're like, no, we're going to postpone the strike to January 15th. Does that then put more tinfoil on the head of be like, what? Who postpones a strike until after? What is happening?
I mean, sure. And no one wants to rock the boat right around an election period. However, as traders, I think I'm interested in ripping Band-Aids off and getting right to the point so that we can actually start to see the volatility we need in markets.
Well, what I like about it is that if the Fed does not need weak economic data in order to stimulate markets, that means they're fine with the stock market going up 50% between now and like March. Like they're fine. If it does happen, they're fine with it, right?
Mm-hmm.
Because stimulating to this degree, while the rest of the central banks around the world are also stimulating, to me says, all right, hats off, let the horses run. We can have crazy upside between now and at the end of next year.
Yeah.
And that we shouldn't really expect any significant drop, any prolonged significant drop until well into 2025.
Possibly. I mean, obviously, today's market reaction was very bullish, and we had a nice gap open. So, at least from the data perspective, the market responded pretty positively. And I think if we see if we see a lot of this data continue the trend we're hoping for, which obviously avoids any signs of a recession, I think that's highly probable that we'll get there. At the moment, it looks like the futures market is pricing in about a 98% probability of a 25 basis point cut in November,
Right.
and another 25 basis points in December. So we're still heading towards a little bit cheaper of the cost of capital, and potentially some improvement across major sectors that obviously would benefit from that. But if the inflationary effects are starting to abate as well, I think that's all good news. So I'm all for it. And I think that's obviously good news for Bitcoin as well.
Well, I do think it means though that the inflationary effects that we're going to see are going to be postponed to. I think I tweeted this out. It's going to be postponed till next year, because the wealth effect here that can happen will be very similar to what we saw in 2020. A bunch of money goes in, assets go up, more spending occurs. People don't curb their spending, and then if we have any sort of supply chain issues because of the strike that supposedly will start next year, then I think we see 10-15% inflation by the end of 2025, beginning of 2026. But that's not our problem today.
Well, I think it's also worth pointing out that this particular strike is sort of isolated to one part geographically in the United States, and that the effects of a supply chain issue on that part of the coast, I think it only represents about a third of overall imports into the United States. And also, it's only specific industries that it would impact. If I remember from some of the news articles, I think it was a big portion of the pharmaceutical industry would have been impacted. But the effects from an inflationary perspective would take a while to really be seen. Especially for retail, right. They're holding a lot of inventory onshore already, and so it would take a while to deplete those inventories before there's really this emergency on the line. So if something did start again in January, we wouldn't see immediate effects from an inflationary perspective.
Fair enough. All right, so I'm glad that you popped the my inflationary concerns there, because
Okay.
what I'm actually the other side of it is, so you're right. The longshoremen, they don't control all of the goods that are coming in, and their automation that's happening for longshoremen are showing that in the United States and some other countries, that more of these jobs are being taken by AI systems and robots, and that, to me, even though that's, hugely disruptive to the industry,
Mhm.
it's sort of like, well, as a consumer, you sort of like want that, right? Like, you want industrialization. It's bad for farmers, I get that, but we want chairs and widgets and stuff like that. So the if this is a sort of like birthing pains for this automation process that's happening within our industrial sector, then it really opens up the possibility that costs come way down, potentially costs come way down for wholesalers and retailers, and then new avenues open up for new businesses and new ideas and new products and stuff like that, that can be imported in and exported out. And so this means, like, rumblings, it's what I would want to see before major systemic change that could potentially lead to like a golden age of opportunity.
Yes. Yeah, and I think the right attitude to have too is that we need automation in the ports. We are like embarrassingly behind other countries in terms of robotics and automation at the ports. And I understand the concern there from a worker perspective, but we would need to shift and retrain a lot of those people to start using new technologies. We need to embrace a lot of this change. Ultimately, I think at the moment, the impact from automation has had about a 5% effect on the overall industry. So we've got a lot of room to, really be concerned about the amount of jobs that would be lost by automation. But as with any type of industry change, we're going to gain a lot of upside from efficiencies that we need as an economy, and a lot of those jobs get shifted into new industries, which start to crop up all the time. So it's a tough one. I think we need a balance of investing in innovation and also protecting workers at the same time.
And what's the trade? Long
What's the
automation.
trade? Long automation.
Yeah. Any
Are we
of these
back to
systems
NVIDIA
that,
again?
absolutely. Why not? All roads lead back to these automation trades. It's like the long-term trend is essentially guaranteed. Like, who's going to argue against that? Fine, you can make the argument against like nuclear power. You can make the argument against certain types of agricultural practices, but automation. Who's not going to want lower prices, safety, higher safety, faster transportation, all that? I mean, okay. And then we'll see when automation comes for the self-driving. That'll be a whole episode in and of itself, because
I'm all for
22%. 20% of the jobs are driving. All right, let's move on to Coinbase now.
Are you aware of the rumors that were circulating that Coinbase was effectively selling paper Bitcoin to BlackRock? Really, there was no evidence for it. It was just pure speculation. Not sure what all this is about, to be honest. All the ETF mints and burns we process are ultimately settled on chain. And they are revising this to where they're actually going to publish this on chain now. So we're aware of how many Bitcoin BlackRock is actually holding as part of the ETF.
I don't believe in, really, unless there's some sort of smoke somewhere, rumors or what could be. I don't really care. I trust that the people are telling me the truth until something shows me. All right, so Mikey, I went down the rabbit hole for Coinbase this week.
Educate me.
So what's fascinating is that the bottom line is there is no document you can point to that proves that on chain they're settling the Bitcoin. All we have is what Coinbase is saying, and then we also have what the SEC regulations are for a Bitcoin ETF to exist, and it needs to settle. It needs to be able to settle in a verifiable. It proves, it has to be settled in a verifiable way, cryptographically verifiable way. But there is no. There's something that shows that, and I think someone was even some people in our comments were mentioning it, and I totally understand. I thought they were wrong. I was like, no, there has to be somewhere where that the Bitcoin is actually being settled on chain, and it turns out that it's not the case. In fact, the only 21 shares, their ETF, they're not showing anything that's settled on chain. They're showing that it is proof of reserves, where the wallet addresses are visible, and you don't know for sure if this is where the crypto is being settled, but at least they're showing that they have some Bitcoin there. However, this is where the whole Occam's razor comes into play. Let's say they're not settled on chain. Let's say they are doing it in dark pools and they're settling that way. Okay, fine. The downside for them doing this wholesale for all crypto is like massive. Like the amount of the issues that they'll run into long term is would be the collapse of Coinbase. And we do have proof of them settling or dealing with crypto transactions on the blockchain, because as a regular user, you can go into Coinbase and see that and get the audit that shows the transaction that matches what you did on Coinbase. So you can actually go check that on the. So they do have the mechanism to settle on chain. The question is, why aren't they showing it? Now, Brian Armstrong, the CEO of Coinbase, did say, "Hey, what are we going to do? Publish the addresses of all institutional clients so that you guys all get to see that?" Like, that's not going to happen. And that's, I can understand that as being fair, because we totally accept that from banks, right? Banks don't have to show all the details of the transactions, and we wouldn't want them to do that. And so where I'm settled right now, there's no proof either way, but where I'm settled right now is that it seems to me that they are doing some kind, or stands to reason they're doing some kind of fractional reserve system where they don't actually have to settle all of it right away, and they're playing some sort of like numbers game where they only really need to, I believe, is in 365 days. That's where like I think that's when the SEC has to like audit it, or they have to prove what they're doing. And so it could be that, within any given month or so, or any given quarter, that they're not actually settling on chain right away. But it was fun because the everyone who's against it, who says that Coinbase is going to fail tomorrow and that they're lying and it's paper Bitcoin, there's no proof of that. And there's also no proof of that they are settled on chain. It's all speculation one way or another. But if you deposit money into Coinbase, you can pull out the money. So
true. I feel like those two are two different topics, though. Worrying the conversation around being able to pull your crypto off of Coinbase is one problem, and I do agree that there are thousands of instances of that happening, and plenty of people who've submitted their view and their evidence showing that Coinbase has either been unresponsive or unwilling to respond to them on the subject of their funds. That's a problem. I don't know why that problem exists, but that's a problem. On the other hand, the implications that an ETF that is supposed to be backed by an underlying asset that they advertise, the implication that isn't real is a huge problem, because then that would represent the value of the ETF would be represented by invisible money, right? Invisible value. Investors are not going to like the idea that they don't actually own Bitcoin when they buy into a Bitcoin ETF. And that is a serious problem. Now, of course, we can make the crypto argument, which is a very common argument, that you should always keep your own crypto in your own wallet, and you should keep it secure and keep it away from banks and institutions. And this is a tough one for me, because I think that there are lots of people in the traditional finance space that aren't quite ready to make that leap. They're not quite ready to jump onto the blockchain and figure out how to manage an offline wallet or a hardware wallet. This is a foreign concept for them. What they have are 20-year-old, 30-year-old, 40-year-old brokerage accounts. And now suddenly there is access to this potential exposure to an asset class that they've never really touched before. And I feel like we need that, because that represents another form of liquidity that helps the value of crypto overall. And I want to support, all venues, all roads that lead to crypto as a serious asset class. But whether or not Coinbase is participating in a legal process with BlackRock and they're doing it appropriately, that's a tougher one for me, because what I'm hearing you say is like, on one hand, there's no evidence for the claim that they're selling they're selling BlackRock paper Bitcoin, but then on the other hand, they don't have evidence to prove that they aren't doing something shady, and it feels like a bit of a quandary here, where, what part of the story do we trust here?
What I care is the ramifications of it, and so, because I was trying to work through, let's say they are doing paper Bitcoin, let's say all of the Bitcoin to do with the ETFs, and they're taking care of a lion's share of the ETFs. Let's say that it is that it's paper. What we would see is that the price of Bitcoin is not moving in relationship to the amount of funds that are floating into the ETF, and we are seeing that. We're not seeing that the inflows and outflows of the ETFs are actually doing anything to the price of Bitcoin. I would have expected a large rise in the price of Bitcoin as they're forced to buy the crypto on the markets. How much Bitcoin is on the in dark pools that they can actually buy before it actually has to hit the chains. We're not seeing that.
Yeah.
The thing is, if it is, the question is this an FTX type situation, right? And that's what to me seems very unlikely. And the only part that makes me sort of concerned is that BlackRock, after this whole thing with Coinbase in the news cycle, amended their agreement with Coinbase to say that they need to be able to withdraw Bitcoin within a 12-hour period, something to that effect.
Mm-hmm.
And so the question around that is like, well, why did they have to put that in now? Like, are they putting that in now because they're worried about it and they want to make sure that they're front of the line for any Bitcoin that needs to come out? Like, why would they need to do that? Why wouldn't that have been done before? And was it assurances that were given to them beforehand that they didn't, and now they're actually more concerned? And so the timing of that BlackRock modification, the cost modification, was suspicious. It was very suspicious. I was like, well, why would you actually need that assurance, and why would it be so public about it?
Mm-hmm.
But then if it was really a problem, you would imagine, well, they would just stop it. But then you go, well, they can't stop it because it would be more embarrassing that they started the ETF and all that sort of thing. So I get the conspiracy theory here. But hands off to the people in our comments who let us know, hey, by the way, there is something potentially going on over here. You guys might want to take more of a look into it.
Yeah,
was totally correct, and it was a very fun 3 days of going through every single Reddit post and tweet and article and news clipping about it, because the amount you can read and not have any information. I go, okay, no wonder there's tons of people being skeptical.
I love it, and I feel like a lot of our commenters have a considerable amount of experience in this space, like well beyond the experience I have. There's no question. Some of these people are very, very passionate about the space. And I like and invite all of those opinions. I think that there's a lot to take away from that and a lot to think about. So it's been a fun discussion, especially since last week.
There is one specific thing, though, that I do find suspicious on the other side, is that, not suspicious, but there were people in the comments saying that thousands to millions of people are dissatisfied with Coinbase, and tons of people can't remove their money from the Coinbase platform. So I was like, okay, let me go see there. When I couldn't take off money off the FTX platform, I mean, I saw posts everywhere. People were sharing their screenshots and all the information that I can't remove my money. Same thing with Celsius. The same thing happened as well. I barely saw any of that with Coinbase. I mean, almost none. And the ones that I did find all seem to be sort of like, well, you could sort of understand why that's the case. Like, they had put their money in before the anti-money laundering laws or regulations were put in at Coinbase, and so now they're withdrawing it. There's this holding period. Some people said, "Oh, it took a long time, but I then got it." But it wasn't thousands. It wasn't dozens of posts I saw, and I was expecting just through a course of customer service to find dozens and dozens of these posts. So I tried looking. I really tried looking. And I could not find anything to that effect, which to me is like part of the signs of like, insolvency or any or the problems that they're talking about.
I think that's the right way to look at it. I mean, there was definitely overwhelming evidence with FTX when that took place, and the market responded appropriately too. I mean, you knew it was real the moment that there was massive sell-offs in Solana, massive sell-offs on all the top market cap cryptos, all went down at the same time, and it just kept selling. That caused a fairly large panic that I think was the signal that something real was going on here. So even measuring markets and the market response is another way to look at this as well.
That's right. And if we take a look at the Coinbase ticker, it's still mapping basically to Bitcoin. I love charts. Like, okay, if I've seen a big thing over there, then I know, okay, potentially there's something in the background that
Sure.
we should be paying attention to. All right, so we'll leave it at that. Any new information on the Coinbase stuff, I'll make sure to keep you up to date because I'm fascinated now. But
yeah, and I appreciate the comments too. Please leave some more. Give me some insight here on your views on Coinbase, and ultimately I would love opinions around whether or not we should be supporting ETFs that are backed by Coinbase as well, and what the appropriate process should be there.
Yeah, you guys worded it very nicely. I love the comments that were there. We got one from I'm always suspicious of a name and then a bunch of numbers after that, but I like what they said, just to be transparent. And those rumors won't start in the first place. These two need to get out more. Coinbase has a history of doing all kinds of shady stuff. And then we also had the next quote from next comment, my next favorite comment. It's easily debunked. Show us the transactions because we cannot find them, and that's what sent me down the rabbit hole of, okay, where are they?
Yeah,
where are the transactions?
Well, we already know that Tom never leaves the house anyway. He would prefer to stay indoors, and I work quite a bit. So you're right. We don't get out much. We need to get out more. There's no question about that.
As far as I'm concerned, if we can just come on here and make all kinds of false statements, and then the comments do the work of sending us information, I think that should be the process that we follow.
It's a good way to educate ourselves. Yeah.
All right, so I want to end on a topic that got pretty heated inside of a group that a crypto group that I'm a part of.
Okay.
And but let me just start off first with a video. This has to do with Cardano and Solana. That's the almost like the debate that I'm always in. Cardano obviously is massively underperforming the price of Solana, but the argument that people make for Cardano is that the technology is far superior, or at least they're moving in the direction of it being far superior, and Solana is part of the move fast and break things sort of crowd. But just to set the context for this, I'd love to play you just a small clip from Eric Snowden speaking at Token 2049, a crypto conference, and I'll come back to you on the backside.
How do we design technology from first principles so we know it's safe?
I mean, when you look back at the Bitcoin white paper, I think what you see is an adversarial approach to the system, and that's really what you have to be considering. A lot of people, and I don't want to name names, but Solana, are taking good ideas, and they're just going, well, what if we just centralized everything? It'll be faster, it'll be more efficient, it'll be cheaper. And yeah, sure, it is, you're right. But nobody's using it, but for like meme coins and scams, because if anybody puts anything significant on it, and then all the states begin moving towards it, it's going to be a system that has levers that people can simply just take from you. You have to be thinking for the adversarial case, as opposed to the convenient, easy, early case. I mean, that's uncomfortable for like a lot of these founder mode people who are like, oh no, we need the minimum viable product, this, that, and the other. Sure, if you're trying to get rich, that'll work. And a lot of people have demonstrated that. They'll continue to do that. But if you want something that will last, you have to engineer it to last. And that means thinking about how it's going to be attacked and making sure it can survive that.
All right. So here, I don't want to get into a whole argument as to, is Solana better than Cardano? Is Cardano better than Solana? I think that's unfair. I don't know. You're not developing anything on the blockchain, are you?
No, I've dabbled in it, but I haven't taken it very far.
That's right. So I've only dabbled on the Cardano side, and I'm very interested in the things that they're creating, but I'm waiting for more libraries, more frameworks to come out. I want to use the WordPress of things on the platform. I don't want to be there right in the PHP to begin with. So I'm fine with waiting. The argument here is that Solana is outperforming in price, and it's silly for somebody to have any money inside of in Cardano or any Polkadot or any of these things that are not outperforming price. You should be chasing price because that's the point of crypto. Like that was the argument that the person I was dealing with in my group was making. I've been in this internal war back and forth with this person. So the question I want to pose to you is that when thinking about putting any significant amount of capital in crypto, is the focus on number go up the most important to you, or tech, or some other thing?
Okay, so good question. I think, at least this is my opinion, is that the adoption of a cryptocurrency, the usage of it, the utility of it, I don't think these things correlate to price as much as we would like them to over the very long run. When I first started looking at crypto as an asset class, my first objective was, how do I value this thing? As I look at any other asset, in order for me to value it, it has to be able to produce cash. And crypto doesn't really have the ability to produce cash for me to determine how to do discounted cash flow analysis, to give any sense of what this thing is valued at in the future and whether there's a mispricing between value and price. The tough part with crypto is that it's purely, from a pricing perspective, has to just be priced by the market, which makes it very technical, which is what got me very, very interested in technical analysis, over 10 years ago, because that was the only way I was going to be able to follow it, is just to look at it from a trend perspective. If I had any evidence that showed me that the underlying technology was the driver for price, other than the popularity of the project and the market participants driving the price up temporarily because of some milestone or something like that, then it may be interesting. But at least from what I can tell, over the very long run, I don't think there's a strong correlation between those two things. In general, the crypto markets are driven by the greater fool theory and by market momentum more than anything, right? As price goes up, everybody starts to pile in. It's a very technical asset class. And if anything happens that's negative for the crypto space, even if it's not specifically Bitcoin or specifically Solana, they all correlate together in times of panic. So they all end up degrading in performance in very short periods of time, right? If there's a drawdown in Bitcoin, there's a drawdown across the market. So if it were really technology based, if it were really because this tech is better, this blockchain is better, this solution is better, this et cetera, et cetera. If it were really better, then you wouldn't see such a strong correlation during times of panic. You would see some big variance between the two over very long periods of time. I get that there are short periods where news announcements can drive price in different directions, and there are short-term divergences in terms of price relative to other cryptos. But for the most part, they all tend to trend together. So if all of that's true, I'm less interested in whether or not the tech is good or not. It's not what drives price.
So the issue that I have with the pricing as the key metric for it is that if I wanted to make a lot of money in crypto, I would not be focusing on any of the L1s. I would be focusing on meme coins. I'd be focused on these things that jump up 10,000% in 3 days.
I think a lot of people do.
Yeah. Well, that's what I used to do, and spend my time doing that. And you sort of like, this is, some people will think of the layer one solutions, the Polkadots, the Bitcoins, the Cardanos, the Ethereums, and they're like, well, you're still getting the risk, but you're not, you don't have the same, the downside as on the meme coins. And I don't see why not, right? If you remember Celsius, if you remember Luna, if you remember Bored Ape Yacht Clubs, and some of these NFTs, people made the case for these things that they're the long-term investments, right? How many times have you heard someone, I'm going to buy this Bored Ape Yacht Club NFT and I'm going to hold it for the next 10, 15 years and I'll appreciate it in value, and it's art just like any other art. Have you looked at the floor price for Bored Ape Yacht Club? It looks like the freaking Luna chart. It's the arguments that people make in order to confirm this highly risky thing they're going to do anyway, I find to be surprising. The entire crypto space is volatile. The whole thing is crazy volatile. Even Bitcoin could fall to zero if the stars align in the right way. And so I go, well, if I'm taking the risk anyway, I might as well really go to the to the Safe Moons, to the Lunas of the world, to the Pepes or whatever, get my money over there, and then I don't have to sit on something for a year through the whole cycle. Just go in, get the coin when it first starts or when it starts to move, make your money and move on with your day. If I'm going to focus on any L1s, I see it as an investment that when I invest money into it is because just like with a share, when I buy a certain amount of L1 tokens, it's because I want to pay attention to it. It's I'm not going to pay attention to it if I don't have any money inside of it. Just like I'm not paying attention to like a stock if I don't have any money in it. I'm just not going to do it, no matter how much it goes up or how much it moves. So I buy the crypto to pay attention to it, and the investment in time and attention within the ecosystem is what I think will pay off. And I finally hit on an analogy that I thought was very apropos to this whole thing. So I couldn't figure out how to articulate it, this idea, and you'll let me know what you think. To me, it's like learning it's like programming languages, right? And so JavaScript, Python, R, Rust, these are all programming languages that took years to.
Sorry, Tom, we're not hearing you. Got muted. Start back from they took years.
Yeah, so Python, R, Rust, JavaScript, these are programming languages that took years to become popular. They had to get the libraries and frameworks. They had to work out the bugs and optimize the language until the point later on where they actually became the use cases that they were made for actually became relevant in the environment. And then boom, JavaScript became popular. And then boom, when you needed R for statistics, because we had the data that we needed to crunch, now it became more popular.
Sure.
But beforehand, it was almost a joke if you're building websites and you were using JavaScript or you were trying to use any of these languages. People go, "Why are you spending any time doing that?" Meanwhile, how many flavor of the months have we seen for programming? You remember ActionScript, Flash, Cold Fusion? Do you remember what was the other ones? Ruby on Rails,
still pretty popular.
Yeah, but it used to be that I had to have Ruby on my CV in order to get any real traction when I was applying for programming jobs.
Sure.
And now I might go a long period of time without actually hearing about Ruby. Some of these Cold Fusion, like when I don't even hear anybody talk about those anymore. ActionScript and Flash, and to me, Solana is the Ruby of cryptocurrencies.
Okay.
It's like really popular right now because they're moving really fast. They have tons of marketing behind them. They're paying to have developers there. They're doing all these sorts of things in order to get this hype, because this is idea that if you move fast and you gain adoption, you gain visibility, that you're first to market and you're gonna capture the whole thing. Meanwhile, what is it that we actually think that crypto is going to be the foundation for? Entire new monetary systems, identification systems, privacy layers, all these sorts of apps that can't have a thing that's moving fast and breaking things. What are you talking about? Who's going to put a government voting system on a platform that they're like, there might be some game changing bug in here that we're not going to find out until later on?
Right. All true. And it runs on similar infrastructure than centralized systems do. So if all of these are all still running on AWS, but they're actually technically slower, what have we really gained from an end user perspective? What advantages do we have other than, I get some of the arguments that a lot of this becomes public, it becomes, open, centralized or decentralized. I understand some of those facets, but I think the point that that was being made there in the video was that they're still building it to try to build this artificial wealth in a space that is driven by momentum, because traders are interested in momentum, and they're not really trying to build something that's disaster proof, right? That will hold up the test of time and the test of cybersecurity and DDoS attacks, and the outages that have occurred within some of these environments is obviously worth pointing out that this is not a fundamentally different technology that has change the way that we can transact in a safer, more secure way.
That's right. I was watching an interview of Anatoly. Yeah, Anatoly, who's the lead on on Solana, and they asked him about this. What about the outages? There were outages before. What about the outages? He goes, "Oh well, have you looked? We haven't had an outage in 10 months."
Okay.
And I go, "That's not enough. That doesn't reassure me. Are you out of your mind? Come back in 3 years and tell me you have an outage." Whereas you ask for in Cardano land, when's the last outage? Oh, never. We've never had an outage before. And you take a look at the actually, I don't want to go into the underbelly of what's going on these networks, but the argument that people make against Cardano is that it's a nerd zombie chain, that they spend all their times researching and doing first principles and putting out papers, and they go, "We want number go up. Unless your number goes up, we don't really care." And I go, there's nothing more attractive to me in a cryptocurrency than a group of ardent developers who care not at all if the price is moving up, right? Like the OpenAI years ago, when they were asking Sam Altman, "How are you going to monetize this? It's costing billions of dollars. How are you going to monetize
I'll ask
it?"
the AI.
I'll ask the AI.
Yeah.
We'll figure it out later on. And he
Well,
was
they didn't-
laughed at.
They didn't need to wait long. If they figured it out pretty quickly, didn't they?
Well, it still took several years, right? It was
Sure.
it was only GPT-3 that they accidentally stumbled upon this format of the chat that turned out to be the thing that the people wanted, because GPT was out for years, and even now they're burning money, but people go, fine, let them burn money. They're making something incredible. But I just mean, or the same thing with Tesla. Like, you're building an electric car. There's never been a new car manufacturer in years, and not only are you going to be a car manufacturer, you're making something new, an electric one. He's like, yeah, we're gonna do it slowly but surely. We're gonna develop technology, and now the Teslas on the street are the iPhones of cars. And so when I see that for Cardano, I go, Cardano seems to have this floor around 30 cents for their coin. I go, great, I'm gonna buy it now. There doesn't seem to be that much downside risk anymore than regular crypto space. Meanwhile, I look at Solana going up and to the right, and I go, what have they made? Memes, dog coins, NFTs? Where's the payment systems? Where are loans? Where are these different things?
Yeah, I'm going to stand on the hill of it's going up because the price is going up.
That's right. Okay. And so that's the thing I'll leave on. If someone says that, I go, fine, no problem. I'm totally on board. Go for it because the number goes up. But then don't tell me bullet point 2, 3, 4, 5, 6 make any difference, because if the number stops going out, all those other points won't matter. You're going to jump to the next ship.
And they don't. So, how many 90% drawdowns have we seen on these cryptos? Whenever there's a big enough panic in the market, whenever things fall apart, it's just a different asset class, but it's largely driven by momentum and panic.
That's right. Excellent. So if you guys get anything from this, own Solana and Cardano. That's the goal. Why choose one or the other? That's what I was telling my my friend the other day. Just own both. And
I was gonna follow that up. I'd prefer not to speculate on which one to go all in on. Just hold a basket if you want to. If you really want to get exposed to crypto, you're gonna do fine if you spread your risk out across multiple in a small basket of cryptos. Now, you're still gonna have drawdown risk. That doesn't eliminate that, and obviously you need to do your own research. But ultimately, if you're not sure which one's going to be the one that moons, well, spread your bets out. That's what diversification is all about.
Did you think Luna was ever going to crash?
No, but I was never really in Luna.
I see.
I remember the craze about it, but I kind of avoided that one. It was still, I think all through those years, I was still just balancing a portfolio of cryptos. So I think it was always the top 30 for a long time.
Okay. Excellent. Because the case for it, when they were saying basically it was a money printed machine. People go, Luna's great. It's a money printed machine.
Yeah.
I go, where in history has that ever been a good idea? A money printed machine, free money. What are you even talking about?
There's no infinite money glitches. They don't exist. Yeah.
That's the Sam Bankman-Fried, the magic box. You put something in and money comes out. You go, then that box is a fraud, because I've seen snake oil salesmen and all kinds of stuff where that occurs. And that's how I feel about the Solana, and which is why I feel like even if I put, 2% of net worth in it, I go, why am I doing that?
Yeah.
I might as well buy Pogs.
So I do want to follow up on a comment that Peter just made here, that Saylor says diversification is selling the winner to buy the losers. Love the quote. Love the analogy. I think you're right. I think he's right about that. I'm saying this from the lens of more of a traditional investor and trader who enjoys my exposure to traditional markets. Of course, I'm going to have biases against cryptocurrencies in ways that aren't going to jive or line up with the more passionate participants in the crypto space. My viewpoint is different because I want to expose myself to markets differently. Saylor is a really good example of a maximalist that is like absolutely tripling down on the long-term viability of crypto in general, right? But not even crypto, Bitcoin. He's like, Bitcoin is the winner, Bitcoin above all. I'm going to own as many of them as possible. This is somebody who believes that the future is a future in which we can transact on Bitcoin, and he sees the utility in it, though. That means he wants to own as many of those Bitcoin as possible, because if we do end up in a world where we're all transacting on Bitcoin and we're no longer denominating our lives in US dollars, well, then he's got more of them than anybody. My wallet's going to have 0.0006 Bitcoin to Saylor's tens of thousands of Bitcoin, right? Or maybe even hundreds of thousands. That viewpoint, I like the optics on that better than I like the optics of whether or not the tech is going to last. Like that argument can be made in a traditional market as well as the crypto market. Like the tech itself still lives independently of the crypto. So if all of that's true, I would probably sooner be more of a Bitcoin maximalist than try to like spend more of my time diversifying. But right now I'm still coming at this from more of a traditional investor lens.
Nice. Well, on that note,
You lost your audio again, Tom.
Oh, should be there. Testing 1, 2.
At least I think so. Nope, it was me.
Oh, no
sorry
problem.
about that.
The way I see it is that I'll buy options and perpetual futures on Solana and Bitcoin, but I'll own Cardano.
Okay, fair enough.
All right. So we'll leave it there for this week for After Hours. That was fun. Crypto heavy this week, but crypto is what was in my mind and my heart in the news. When the sky falls or Jesus returns, we'll talk about that. But until then, it'll be whatever happens that week.
Did you want to do a quick Bitcoin technical analysis update?
Oh, yes, absolutely.
Okay.
Perfect.
Because since we're on the subject, I did want to point out that global liquidity had a sharp pullback this week. So it's kind of worth highlighting.
Yeah. You want to share your screen?
Sure. So yeah, I think obviously we keep hitting these reversals, and I'm going to put up this last one here. I thought we were going to achieve a little bit of a higher high here, but now we're going to need to hurdle 70K again in order for me to start getting interested. But it was this global liquidity trend and pullback here that had me just sort of, interested in what's going on here. We seem to have this really nice uptrend even during this descending trend in Bitcoin, but now a little bit of a pullback. So what's your take? What do you think's happening here with liquidity?
So I believe I was seeing some reports of that was issue within the repo markets, which is code for collateral within the world somewhere is going down drastically in value very, very sharply. And when I see stuff like the I believe was it the EU that are showing 100% debt to GDP, and then we have the China coming in with massive amounts of stimulus, and then all the stuff happening with the Japanese yen. It makes me, and then the 50 basis point cut from the Fed. It makes me think, okay, there is actually a systemic issue in the financial markets. We don't see it yet. We don't know where it is, but there is a systemic issue, which to me makes sense with this steady rise of liquidity, like you see on your chart, and then this pullback here. And so I think we should be looking out for a potentially one big dip in financial assets that are highly correlated to liquidity. So Nasdaq, Bitcoin, and currencies. I think we should be able to see that, but because they're taking preemptive moves, I don't think we're going to see Bitcoin at 55,000. Like I don't know that we actually turn over and hit down because they're doing the emergency liquidity injections now. So we'll see. But there must be a collateral issue at some place somewhere.
Copy that. Well, one thing that's nice to see is that despite this sort of descending trend in Bitcoin's price, it still would have been your best bet year to date here among all the other traditional asset classes, even the Qs, even XLK, which some of these top ETFs are usually what I'm taking a look at. But gold was surprising, 28% this year so far, but 38% still on Bitcoin. Nice to see.
That's the thing. We're since 2009, really since 2012, the game is liquidity. We're trading liquidity. That's all everyone is trading. All these assets are correlated to that. And you're hard pressed to find long-term moves that beat the buy and hold of liquidity, right? So those people who make money in uranium, those people who make money in the oil trade, or all these different things, sure, but you can't hold that for 4 years. Whereas these liquidity trends, it's a guarantee that the financial institutions and central banks are going to pump liquidity in. There's like no downside to the move. Like there's no risk that Jay Powell's going to come up and go, we should really live within our means and really pay down the debt, and we're going to cut down on it's never going to happen. It's never going to happen. And so liquidity, the trade, and the asset that's the most correlated with global liquidity is Bitcoin.
Got it.
Yeah.
Well, you heard it here, and that was Tom's financial advice. Please direct your lawsuits his way. No, I'm kidding.
Subscribe to my blog, buy my service.
You have your course you're selling on this soon, right?
That's exactly right. All right. So what do you think Bitcoin's gonna? Are you bearish then? Now, are you leaning towards bearishness?
Still in a wait and see pattern right now. I think I've mentioned a few times, like I want to see some confirmation to the upside before I get interested again. But if we start breaking some key levels to the downside, then it's time to avoid crypto for a little while.
I see. I mean, I always feel this way where I want crypto to fall because I think that long term it's always going to go up. So I'm fine with more dips. Please give me more dips.
Sure.
I never have any problem with that.
This one's not a very good dip though. It's more sideways than it is dippy. I want a stronger pullback than this.
And it's happening exactly where, I'll just share my screen real quick here. It's happening exactly where I would expect this squeeze to happen. So like we have this large flag move over here. Mm-hmm. And so I would expect to see these trends to meet. So it's only really around this area here that I think we could even get the volume necessary in order to break out. Yep. And we've had this long period. And so I was sort of foolish before when I thought that this breakout was going to break out here or here, because there's just too much of this flag. And so it's fine. To me, this is one big consolidation. And if this consolidation plays out, then I think with a crisis and, with how central banks are adding liquidity now, can you imagine what they'll add in if we have a crisis? I mean, It'll be insane. And I think that's what drives us higher up. And gold being up on the year, right? Gold goes up because central banks are buying gold, because there's people are betting against the structure of the financial system. I think that's what's brewing, but it's 6 months before I think something severe happens in a negative way.
Yeah, I could see that. I think the other interesting thing right now in terms of referencing the consolidation phase here is how low the Bitvol index is on the historical volatility. I don't know if you follow the Bitvol and ETHvol indicators, but right now we're at the 56 range. I mean, we're so low in terms of long-term volatility that this is a tightening range that I would expect to break out from.
Right, exactly. So that's why I'm long now. I can't wait for confirmation because I'll jump out a window if I miss the up move. I can't wait for confirmation, but I get the waiting now.
Yep. All right. Well, we'll see you guys next week.
Excellent. And it's as always, Mike, it's fun, and I